When you told me the camera's on, was I like picking my nose or something or what?
No,
was I doing
you were
something appalling?
doing a shot of something. I don't know what you were doing.
I have to do shots of several things to do the show. Can you believe they still let us come back week after week after all the bullshit we spew?
That's very short-lived, man. So let's take advantage of it.
Are you getting hit with hurricanes down in Florida or no?
No, it went above us. I mean, the amount of people, they must be telling everyone up north that everyone in Florida is drowning and dying of wind because literally every family member, are you guys okay? Yeah, I mean, the top of one of my trees broke, but otherwise I'm fine. Not even
imagine that? Them trying to scare the shit out of us?
Yeah. Shocking.
Okay, let's end this nonsense. Let's start the show, the Trader's Edge. Today we have our favorite guest. Well, we say that to a lot of people, but she really is our favorite guest. Here we're not lying. We have the Chief Investment Officer of New Edge, Cameron Dawson. So, Cameron, it drives Bobby absolutely
me crazy,
nutty that my picture's higher than his on the intro. I think
mine is bigger than all of you guys.
Yours one is bigger. Yes, you deserve it though. How are you?
I'm wonderful. I've never been so excited and so deflated so quickly. Our favorite guest. But we say that to everybody.
But then I said I wasn't lying when I say about it to you, right? You are our favorite guest.
You know, it's great, Cameron, when liars say they aren't lying. It's really dependable.
We do lie. We tell all our viewers that we lie. We lie about a couple things. We lie and we tell you that we're only going to keep you on for 20 minutes. And then if you're in the middle of something, we keep you on for 40 minutes. But you're used to us. You've known us for years now.
We also lie about liking the Fed.
No, I don't lie about liking
I don't
the
lie
Fed.
about it either.
When did you ever lie about that?
Right. He one time told me that we have to stop bashing the Fed. I'm like, I
did. I was
my
bored.
deathbed, I'm going to be bashing the Fed. I think
I was seriously bored with bashing the Fed, like seeing all these people going on. We got to get rid of the Federal Reserve. It's like, okay, that's like the people threatening us online. It's like, come to the door and say that. You know,
I'm in Chicago, as I've shown on this platform before. Come to the door because I am armed with my baton. I just had it in my hand this morning on the L. I brought it into my hand when some guy was like walking up and down the aisle, and I just held it like this. And I don't know if he knows what it is or not, but it's very scary. But anyway, they can come to the door anytime they want, Bobby. Cam, let's talk about like actual shit. Okay, I'm of the opinion that a lot has changed in the last 2 days. We saw that JOLTS number come out. And again, and Mike Singleton, who is brilliant, we love having him on the show, talks about the fact that JOLTS is kind of a goofy number. It might not be a good number, but the direction of it is somewhat important. The direction of it is definitely one way. Then consumer confidence, then GDP. Has everything changed in the last 2 days, Cameron?
So the first point is that JOLTS is a little bit of a goofy number, and it's considered sort of a secondary number. It doesn't matter nearly as much as those primary numbers like non-farm payrolls or the unemployment rate. I think the biggest question is that we are seeing this easing in the labor market begin. Now it's immaculate in its nature, meaning that right now what you're seeing is all of the easing is coming out of non-real numbers, job openings. They've been high and elevated for some time. So job openings falling really doesn't hurt anybody. The expectation is that fewer job openings means that there will be less wage pressure, meaning if there's not as much urgency for labor, there's not as much bidding up of each individual looking for a job, maybe you'll see less wage pressure. But for right now, you're seeing this easing in the labor market at no expense to the real economy. And Powell talked about the hope for this back even at the end of last year by calling out job openings as a key way that they needed to get those down to ease the labor market. But then the question is, and as we know, rarely do things that are very extended on the upside, pulling back to trend, just stop there. Most of the time you undershoot and you go below trend before you start to recover. So when I get back to that big question is that usually we see job openings as a sign, a leading indicator for the rest of the labor market. And as well as quits, right? This idea that you're seeing fewer job openings, people quitting their jobs, there must be some weakness brewing. For now, we're correcting to normal and to trend pre-pandemic levels, but will we correct deeper, which means that it actually does lead things like non-farm payrolls higher, or things like the non-farm payrolls lower, and then end the unemployment rate higher. It's a good
Kim,
question.
if I could, I want to read something off of your latest note and get you to kind of expand on it. And I'm prepared with your note this time because I loved it. First of all, kudos to you knowing a punk song from 1969. That was my shit. I mean, all that punk rock stuff, Black Flag, all that, the Stooges. When I first read this, I thought you were talking about the Three Stooges, and I saw the song.
Who I also love.
That's us.
Right. Well, yeah, that's us. Exactly. So you wrote JP Morgan's language model scored the speech as hawkish, referencing Jackson Hole, right? Jerome Powell's speech. But the least so in all of 2023, while the market interpreted the speech as near-term hawkish with higher 2-year yields and the probability for a November rate hike climbing by 8% to 42%, which was something I talked about as well. But through this reiteration of hawkishness and the market's reaction, Powell was far more balanced in the message compared to 2022. So break that down a little bit as to where that balance, where you saw that in the speech itself, if you don't mind.
Yeah, the title of the piece is "I Want to Be Your Dove," which is the play on "I Want to Be Your Dog" by the Stooges.
Great song.
And this idea that under it all, for all this hawkishness that Powell has been communicating over the past, let's call it, year and a half since they started raising rates, that in reality he's always looking for avenues to lean more dovish. And though he started this speech and said, this time I'm going to talk for a little bit longer, but it is the same message as last year, in many ways, it was a very different message. It was, yes, we still have more work to do and inflation's not back down to our 2%, but where the risks were very much skewed of doing too little was the biggest risk. Now they're talking much more balanced about the risk of doing too much. And the other thing that is eking into the conversation is already a discussion of when they could be cutting interest rates. Now, of course, that also leads to the discussion of what is the neutral rate. And it's this nebulous rate that's supposed to be neither stimulative nor a drag on the economy, meaning it doesn't have any effect whatsoever, in debates if it should be higher versus this cycle or the same compared to prior to the pandemic. But there is now talk, and Powell acknowledged it even in July, of the conditions that they would see to cut interest rates. Now, none of these conditions are talking about a recession. They're actually talking about cutting interest rates when inflation could still be above their 2% target, but just headed in that direction. I think that's one of the reasons why you saw the uplift in bond yields coming out of the July meeting, mostly on the long end of the curve, as people said, oh, wait, maybe you will be more tolerant of inflation. And then there's all these discussions about real yields, which is really important as we think of the next move for the Fed. That gets a little bit wonky, but it's something that's really interesting.
So you, during the Fed, first of all, I owe you both $1 because the last time we spoke was a couple of weeks before the last meeting, and I said they weren't going to hike again, and they did. I'd like to re-up that bet. I still think they're not going to.
And remember, my dollar is inflation adjusted.
Inflation, of course, is inflation adjusted, right? At what are we using? The actual CPI, the bullshit Wonder Bread indicator, or are we going to use a real? But anyway, the point is that in the speech, he also said. First of all, I want you to explain why the real yield things are they watch those so much. But I also, one of the comments in the speech was that we are navigating by the stars on a cloudy night. What do we pay these people for if they're basically telling us, yeah, dude, I have no idea what we're doing. We're just going to give it a go. That's the way I interpret it. Is that the way to interpret it?
Yeah, I mean, look, there's always uncertainty in monetary policy, and they talked about it all this time about long and variable lags. I mean, that's essentially saying we take action and we don't know what it's going to, how it's going to impact the real economy. And it could be a multitude of any factors. And it gets back to probably the most critical of all of these is asking the question of how much of this inflation did the Fed cause? Then how much of this disinflation has the Fed been the driver of? And I don't know about the latter, if we can say a lot of this disinflation is coming from the Fed Powell actually took some victory laps and saying, here, look at all this disinflation that happened and things that are interest rate sensitive. Look at, housing activity slowing down. Look at used car prices coming down. That's us. We did that. Yes, there is housing activity that slowed down because as much about the anticipation of higher interest rates, where people starting to pull back, meaning rates are higher today, and yet we're seeing housing activity start to reaccelerate. But then if we get back to this question of, again, how much of the inflation did the Fed cause? That is another question about, okay, yes, we know there were supply chain issues, but keeping interest rates far too low that led to some of this housing inflation, or all of this housing inflation, plus the structural issues. So when we think about them navigating, they don't even know what they caused versus what they didn't cause. And so the tools that they use to fix the things that they may have caused or not have caused, no wonder they don't know. And it does speak to the complexities of monetary policy and the overall economy. But I mean, they're never going to know.
So the second part was, you mentioned real yields. Could you give a quick thumbnail explanation to these guys listening what real yields are and why you and I feel that they're important in determining what the Fed may do next?
And before you go, Cameron, I want to put up your chart from your piece of real yields, if I could, so that you can kind of point to it as you're talking about it.
Yeah, so real yields are nominal yields. So when you see the quote of this is the 10-year treasury yield minus inflation, so it's meant to be the real cost of money. Now, there's two ways to define real yields, and it's really based on what the inflation number you use, because there's different ways to measure inflation. You can measure inflation by observed inflation, looking at the economy and saying CPI and PCE are doing this. And that is inherently backward looking, or you could try to go to forward looking measures of inflation, things like inflation break evens. These are market implied inflation measures where the bond market, you can kind of imply it from the different levels of yields, where the bond market is saying, we think inflation is going to average this amount over this period of time. That is incredibly flawed. Inflation break evens are very volatile because they're thinly traded. And so there's not a lot of information value to those. However, they are used when you quote real yields at the long end of the curve. And Powell quoted real yields during his speech, and has quoted them many times as an indicator to say that financial conditions are tight. Now, if we get back to the two definitions of real yields, they tell wildly different stories. So I don't know if you have the chart using CPI. Oh, that's the one. So this is the Fed funds rate minus CPI. This is that idea of the observed inflation for real yields. So all I did here is take the Fed funds rate and remove the core CPI, and this is what you're left with. What you can see here is that real Fed funds rate is at 0.8%, and that it only turned positive just over 2 months ago, which means that we've barely been in somewhat restrictive or above, and we could argue what is a neutral real rate as well, but above stimulative monetary policy for about 2 months. And if you look back in time, in prior cycles in the 2000s and in the 1990s, we sustained at real Fed funds rates that were far higher than they were today and for far longer. So the fact that the Fed is talking about cutting interest rates because real yields will move higher as inflation drops, that is inherently dovish, because look at the history of how high real yields have gotten. So to get back to that concept of why real yields will climb as inflation falls, again, remember, you're subtracting inflation from some observed nominal yield. So as that subtraction gets smaller, as inflation gets smaller, then you're subtracting less, and thus the real yield rises. And so they've talked about to say, hey, as inflation nears our target, real yields will be moving higher, and thus we could cut interest rates because interest rates will be getting increasingly restrictive versus where inflation is. Now, if we're at 525 or 550 in the Fed funds rate today, if you take 3% of a CPI, core CPI out from that, you're still at 2.25%, 2.5% on a real yield. And you'll see, compared to history, that's actually not that high in prior cycles. There's one last really important point here, which is that the market implied real yield, the one that uses those inflation break-evens, is much higher. And the reason it's much higher is because inflation break-evens have already priced that inflation's going back to 2%, meaning that the bond market already has priced that this inflation episode is behind us. So when we think about calculating real yields and the Fed is saying, oh, well, as inflation falls, real yields will move up. Well, the bond market already has that priced in. So real yields at 2.3% or so on the 5-year and 1.8% or so on the 10-year real yield, that already has priced in the deceleration in inflation, meaning as inflation falls, that real yield won't climb. So which one are they going to look at to say we're cutting interest rates? Because the observed one says you could go far higher for far longer and it's not a problem in past cycles. The implied one already reflects that you've already gotten back to 2% inflation. So if I asked the Fed one question, it would be, which definition of real yields are you choosing?
Have they ever answered it? I mean, like when they were wrong about transitory, it just seems to me like they were obviously using observable course PCI. So that's sort of backwards looking, correct? You're not looking at, and how reliable is it to look at? You mentioned in your note and just now as well that, you're talking about break evens, for example, whether it's 5-year, or 2-year, you're still looking at a situation of estimates, correct? Versus what's actually been observed.
Yeah, I mean, both of them are wildly imperfect. And then some people will argue, well, you should use forward-looking inflation expectations using the UMISH survey. And that's even more flawed than any of these other metrics. And so, I think that at the end of the day, all of them are imperfect, which supports this idea of you use sort of a blended measure of all of them, that confluence of evidence. But for the Fed to say that real yields have already moved up a lot and they're positive, well, yeah, they moved up a lot because they've never been lower. The Fed had never been so easy when inflation was so high, even back to the 70s. And then if we think about that, oh, yeah, they're positive. Well, they're barely positive on observed. And yes, they're positive on implied inflation, but they're not going to go much higher simply because that implied inflation already incorporates inflation moving back to 2%.
So I'm going to put something else up. Do you think Jerome Powell completely ignores the Chicago Fed Financial Conditions Index, which is now at the easiest going back to, I think it's March 2021 or February 2021, somewhere in that range? You can see it made a new cycle low right here. Is there just too many inputs for the Fed to worry about, or are they just like ignoring this completely? And do you look at it at all?
Yeah, I think he's probably just ignoring it because it has the word Chicago in it to mess with Jimmy. That's my guess.
That makes good sense, actually.
Yeah. I think that's a rational conclusion. It has been so shocking to me that, and I believe it was the January or February, there was some interview that Powell did for some economic conference. And one of the big questions, because at that time we were seeing financial conditions ease a lot on whether it was the Chicago Fed or you looked at Bloomberg or Goldman financial conditions, which are broad financial conditions indices. They include things like the dollar, interest rates, equity valuations, credit spreads, that they had all moved into really easy territory. And he was asked, is that a concern as you fight inflation or you're trying to get demand lower in order to keep inflation low? And he goes, no, inflation, financial conditions are tight. We all looked around and like, which ones are you looking at? And it's because they were using a very narrow definition of financial conditions that's just real interest rates. And it was the San Francisco Fed president, I believe it was Mary Daly, who had written a paper on it recently, like at that time to say, oh, well, we can just look at real interest rates. But again, as we just talked, like real interest rates themselves are very difficult and flawed to interpret. The argument for using broad financial conditions, like the Chicago one, is that it is actually a leading indicator for growth and inflation, so nominal growth altogether, because it impacts through the expectations channel of activity, and expectations are important for economic activity. But it also reflects the wealth effect, it is rather ironic for them to ignore things like equity valuations and credit spreads after doing QE, which intently or expressly meant to target the wealth effect by getting long interest rates lower, pushing people out the risk spectrum. One of the goals of quantitative easing. So I don't know why they've decided to adopt such a narrow definition, but I think that probably I would argue that some of the better economic activity that we've been experiencing is a reflection of financial condition easing that we've seen this year.
First, I don't think we should discount when we say why they're ignoring certain things. We should not discount the fact that perhaps they are dumbasses. And basically, they've shown us several times over the last few years that that's quite a possibility. Based on some of the things you said loosening up of the labor market. You mentioned real yields. You mentioned that they might be ignoring Chicago Fed financial conditions. Are you saying that they're not tightening anymore? There's no need to tighten anymore? And how are the equities going to respond to that, in your opinion?
I actually think that September and November are still live meetings. I don't think that we've seen enough loosening in the labor market that if we were to get a hot CPI print, that they would ignore it and not hike one more time. And I wouldn't also ignore reacceleration in inflation. You lose the benefit of base effects if you were to see oil prices move higher. Oil is starting to, its trend from an absolute standpoint looks a heck of a lot better than it has at any time in the last 12 months. So if oil energy costs move higher, you could see headline CPI actually reaccelerate on a month-over-month basis. And certainly they won't be comfortable with that, even though they say they're looking at core. So, if you don't rule out this idea that inflation could move against them, then yeah, the meetings are still live. And I don't think that we've seen enough loosening in the labor market. Remember, you haven't seen a negative print on non-farm payrolls. You have not seen initial jobless claims blow out. They are above average for a seasonal perspective. On a weekly basis, they've been running above the prior pandemic 3-year average for quite some time, pretty much all year long. But it's not weak enough to suggest that they could have to come to the rescue anytime soon. So it's, last year our phrase was like, it has to get worse before it gets better. Meaning you got to see a lot more weakness before the Fed comes to the rescue because inflation is high. And I think that still is somewhat the case, though, knowing that Powell is such a dove, that it's a good question of how quickly he'll be willing to react to weakness.
Yeah, that was the thing that I took from your note when I read it, is that I was, I've always sort of, I don't want to say defended Jerome Powell because I don't like anyone at the Fed, but I've always said, yeah, exactly. I've always said that he seems to say what he actually does. So when he was saying inflation was transitory, he didn't touch rates. And the only time he didn't do that, I think, was during the taper tantrum, right? He just reacted quickly. But then all of a sudden he switches his view and does one of the most aggressive hiking cycles that we've ever seen, right? And now he's kind of calming it down, but he still says we're going to hold rates, and he wouldn't budge on 2% being their inflation target. So the question is, we talked to Steph Pomboy a couple of weeks ago, and from Macro Mavens, and she said she thinks that he'll cut rates, but he'll continue with quantitative tightening. Mm-hmm. Do you see that kind of a scenario, and will he publicize that, or will he just quietly do it?
Yeah, he actually talked about that at the July meeting, of that is potential. But it all gets back to that whole real rate discussion. The reason that they would be cutting rates in 2024 and doing QT is that if real rates were moving significantly higher and becoming restrictive on their own, just because inflation was coming down, and that's when they would tweak policy lower to being more of a neutral rate. But it still gets back to my point of, well, they're not that high, real rates. And even if you move them back to 2% compared to history, they're not that high. And then if you use break evens where they are that high compared to prior cycles, you've already priced in the deceleration in inflation. So if they are in that scenario where they're cutting rates and they're doing QT, it's because the economy is still rather strong and robust, and that inflation has somehow come down enough that real rates look screamingly high, and they're fearful that those real rates would then cause the economy to collapse. I'm still of the camp that I don't see them doing this immaculate rate cut until you actually see economic weakness. And maybe that economic weakness isn't deep before they start cutting. And then it's a matter of how much the economic weakness is a function of the true economy underneath having issues, balance sheets having issues, versus just a reaction to interest rates. And because that's where you get to the pushing on the string. The Fed could be cutting interest rates, but you're plummeting, and it doesn't really matter in the short term. So it's a really good question, but I do think, given the fact that they are afraid that inflation could come back, that reaction mechanism for them to want to cut rates swiftly seems like it will be longer this time around than in prior cycles.
So here's my question in regards to equities. And over the last, call it month, maybe month and a half, I've been a bear on equities. That might be changing, and we're going to put up a chart probably after Cameron's gone. Bobby and I are going to break down some charts that we're looking at. But I thought this was going to happen. I thought the Fed was going to tighten and talk tough. Fed was going to tighten and talk tough. Something would break, a la when the banking crisis looked like it could be something that spread. But now it seems like economic data is softening at a gradual pace. The soft landing thing is happening. I thought something would break, stocks would plummet 10%, and then the Fed would all of a sudden be dodging burning timbers falling from the ceiling and be compelled to ease. It doesn't look like that's going to happen. And is the stock market ultimately going to force the Fed's hand to ease, or is just the economic data going to soften?
I mean, if the economic data softens, the stock market, likely softens as well eventually. You always
did in the last 2 days, though, right? Stock market loves these
2
last 2 days.
You want me to extrapolate 2 days at the end of August, right before
you
Labor
win.
Day
Go on.
future?
Forget I said it. Scratch it from the record.
I thought we were traders here.
Right.
Boy.
Look, there's always this moment, where you're like, oh, good news is bad news. And of course, if you went back, bad news is good news, and that was certainly the whole mantra throughout coming out of the great financial crisis, is that every time you got bad news, it just meant, more sugar from the Fed to be able to lift valuations higher. Look, that's very, that's very possible. I mean, I think the difference here, of course, is that you have an economy that is, it has pockets that are recovering, pockets that have remained strong through this whole environment. And if we think about the earnings picture, and maybe this is the best way to frame it, is that right now what you have is an expectation that earnings are going to start growing mid to high single digits in the fourth quarter, and then growing low double digits to low teens over the course of 2024, on this idea that we're not going to have a recession. Recession's not priced into equities at this time. And so if you were to see a string of economic data that challenge that view by the earnings estimates, then that's where the market would stumble. And I think it's one of the reasons why the market has held up so well, not just this whole year, but over the course of this last month, where we saw a little dip and not much really down on the downside. And I think the downside was capped because just as the market was starting to sell off, you actually were seeing earnings revisions move higher. So in the past 2 weeks, you've seen the estimates for 2024 go from 218 to 222 because of stronger economic data. And if economic data continues to surprise to the upside, which it isn't, economic surprises are rolling over. But if you continue to see revisions higher, the market stays well bid. Where you start to get more concerned is that when those earnings revisions roll over, that's when the market will have something more of a protracted kind of downturn. So at this point, what you're pricing in is no recession. That's what's being forecasted into equity markets at this time with valuations, with earnings, and I would argue with valuations. And so watch earnings revisions. That's probably your biggest, most important input in making an economic or an equity prediction over the next 6 to 9 months.
So I wonder if you could have, so this audience, we've had some really high level questions. We've had some really basic questions. We're still kind of learning this audience. So I wonder if I can get you to help them from a perspective of, I think one of the things that people respect so much about your work is that you're very consistent in terminology, for lack of a better word. So when you don't know what the fuck the Fed is using for real rates, right? You're like, what are you guys using for real rates? I want to take that to something you wrote in here where it said, um, when the S&P traded to 20 times and the NASDAQ traded to 33 times next 12 months earnings. There's obviously several ways you can look at valuations, right? Whether it's discounted cash flow, whether it's precedent earnings, whether some guys use book value. Why do you always use this? And are you able to sort of show the math to help people look at it themselves?
Yeah, I always use the next 12 months earnings number because what it avoids is short periods of time when you're rolling your models forward. So if you use calendar earnings numbers, what you end up having is periods where you're at the end of the year, equities are starting to already price in the following year, but you're using an old number. So from, let's call it September through December, that number is actually not reflective of what you're looking towards. So it's always important when we think about valuations is that forward number, and it is a blended number, and I use a Bloomberg calculation. I can share the definition of exactly how it's calculated, but this is the way to allow you to reflect the current estimates, and it's blended between current and the forward estimates, and that allows you to have that smoother kind of experience and really be able to say, what is the market actually pricing in today from a behavioral standpoint, almost in a way, because this is what the market is seeing versus kind of calendar adjustments. It's one of the most important reasons why you have to be very, very clear about what definition of valuation you're using. Because when I say stocks have never traded above 20 times forward earnings, except for during the tech bubble in the late 90s and during the COVID bubble, people say, oh, no, of course they did, because they traded at 20 times in 2008 when earnings were depressed. And I said, no. I'm using forward earnings numbers, which takes out that you're depressed right now, but things are going to get better kind of dynamic. And what you see is then you can actually judge today for what today is versus these bursts of valuation disorientances that you get at times when earnings aren't reflective of the ongoing earnings power. That's what we're trying to capture. Like, what's the steady state earnings power, and then value it from there. So if you use that metric, then what you can look to is over the very long term that, yeah, you haven't traded above this level for some time. And that's where that valuation discipline starts to come in to say, I'm not saying markets can't go up, but when we went from 15 and a half times to 20 times, or low 20s to 33 times on the NASDAQ, that was 100% move higher in the equity market. And great, awesome. We had this valuation re-rating. You would have to assume that we go into a new paradigm to see the same re-rating from today to next September, if you were to see the same degree of upside as you have already experienced. Now, I know that that's not helpful in definition. I would say not everybody's counting on the same degree of upside, but it does put you into a position where you have to rationally say, what is being priced into today's numbers? Let's compare it to those forward earnings estimates, which we already talked about. We have no recession. And then that's where you say, okay, some discipline is necessary on the index level, and where could I find value on individual kinds of names?
So there was a question. I'm going to change the channel to China, Aussie dollar, copper, and that whole area there. So when you look at some of those charts, this is a question that came to us on Twitter from one of our viewers. It looks at those three things, platinum included. Is the Aussie dollars plunge? Is that just a China story? How does this China story play out? I see a lot of people predicting that China's 40-year run is coming to a close. Are you of that opinion?
Yeah, I mean, obviously, China has entered into a new structural phase of its economy, and that should be taken separately from what the equity market does, because it's wild. The FXI, which is the large cap China ETF, has been flat. It's trading at the same level since 2007. China's had some pretty big growth since 2007. And the thing to learn about, the thing I think about China is that China is more of a trade versus an investment based on the last 20 years, meaning that you've been effectively flat, but in that time you have had massive booms and massive busts. So we've been in this really wide trading range for China for quite some time. And if you look back over the last time since 2007, what you see is there's this peak in the FXI at around 55 that it hit in 2015, 2018, 2021, and even back in 2011, 2012, kind of in that area. Every time you reach the top end of the channel, the market sells off. And you get to the bottom end of the channel and you have a rally. And so right now we're in the bottom end of the channel. If we have, your people have talked about how everybody's given up on the market and how they're going to, like things are so bad, they got to get better. It can't get any worse. You could have a big rally in Chinese stocks rather easily just because positioning is light. People have been trying to call this turn for some time. We had a big rally back at the end of last year, sucked a lot of people into that market, and then it's all been reversed. The thing I would say is that if you were ever going to play in China, keep it on a really short leash, because have the pigs get fat, hogs get slaughtered mentality is that you have a big run. If you reach the high end of that channel, yeah, maybe something huge changes and you see a breakout. But what we've seen and since 2007 is that you just are stuck in a wide trading range. The best definition for it, and the guys Quinn and Turner talk about in their book Boom and Bust, is that it's casino capitalism. These are not developed equity markets like we have in the US, and you have stimulus that causes people, they're telling people don't sell stocks. Like that's not
that?
That's
bullshit,
and
right?
it's not a high quality market. It's not very well developed, and it's used for betting and trading. So at the end of the day, if you're going to do anything in it, very short leash.
I have a quick question, then you can answer short, and then Bobby gets to the last question, and then we'll let you go. Copper for me over the last 11 months, I have a relatively big position, but it was a trade that was supposed to be a 5-year trade. I actually, when I look at it, it hasn't performed the way I wanted it to, but it has performed pretty well when you consider that China hasn't participated in a tailwind for copper. Do you view that as a coil? And again, this is confirmation bias. I'm looking for a pat on the back, probably, but an honest pat on the back. What do you think?
Yeah, I mean, that was the point that Chris Barone made, is that if everything's so bad in China, why isn't copper breaking down? Like you would expect copper and iron ore to break down, and even flag things like the ratio of KWEB, the Chinese internet stocks to the QQQs, US internet technology stocks, and that hasn't broken to new lows. So maybe for all the bad data, for all the economists' headline articles, maybe we're reaching the point where people just can't short or sell anymore, and maybe things aren't as bad because you're seeing a hold up in things like copper. So I think that's the case. I mean, the other thing I would remember is that the highs that we saw when copper kissed 500 very briefly back in 21 and 22 was peak EV optimism. That was when you were going to roll out EVs in rapid pace. That's when Nikola was trading at like crazy valuations back in 2021, Tesla trading at crazy valuations. And so how much of the price of copper that day was, or at that time, was more of a function of the meme trend? I meant meme-e, not, I didn't say meme.
No.
I said meme with a Y, I didn't pronounce it wrong. But that, this idea about electrification, and that it was just another offshoot of speculative to the moon kind of trading. That doesn't mean that you don't have long-term supply and demand imbalances for that 5-year trade. I would just think that there would be a fair amount of selling pressure around those high 400 levels, just because so many people were brought into the trade thinking that EV stocks were right around or EV was going to change the world.
So Cam, I've got actually 2 viewer questions, so I wanted to sneak those in. One of them is from our buddy Tim McLean, who watches all our shows, especially when you're on it. He's the one whose daughter is same university as you. So how did R-star become a thing in 2023, and when it's never been discussed before? Why is that sort of the term of the day for the Fed?
Well, I've discussed it. So the in the world have discussed it. The reason why it is top of mind is because the Fed's projection of neutral rate, or R star, has not changed since prior to the pandemic. So what that looks, so everybody looks around and goes, but if you can raise rates to 5.5% and the economy is fine, what does that say about the neutral rate? Because we've all been thinking that this economy cannot tolerate higher rates and that the economy will crash because interest rates are too high. Well, if you can have a strong economy with high interest rates, doesn't that by definition mean that the neutral rate should be higher today than it was possibly in the last cycle?
So then we
Can
have
I chime in there real quick, Bobby?
Yeah,
'Cause
go ahead.
I say no to that. I say the difference this time is the 5-year period before they began hiking rates, 10-year yields average 1.96%, allowing ample opportunity for companies, individuals, everybody to lock in duration and become a little more insulated from a hiking cycle right now compared to the past. You just pointed like you're surprised a dumbass like Jim said something like that. That's relatively insightful.
I just think you've been reading my pieces. I think that's all that this is.
Now you got him.
Because I wrote about that at the very beginning of this year in February, saying this is why I don't think that there's going to be a recession as quick as what the market is expecting.
Yeah, I wrote about it in January. No,
because this is the long tail of QE. This is the unintended or intended consequence of, it's not just the last 5 years, it's been since the great financial crisis, of suppressing interest rates on the long end of the curve, allowing people to term out their debt, and effectively making short end Fed funds rate types of policy less effective because people are not sensitive to interest rate hikes when they've turned out their debt. So I 100% agree. And I think it is the exact reason why the neutral rate should be longer is because of the long tail of QE.
So I'm going to put up a viewer question, and then if you need to go, we'll let you go. It seems that with the new addition in South Africa, BRICS now controls over 50% of the world commodities, including energy. Do you think China's next target would be finance and the dollar? I've got something for that too, but go ahead.
Yeah, I mean, what's the one thing that we have that China doesn't? It's a reserve currency. Now, you're not going to get people using a controlled currency as the main reserve currency, but I do think at the margin, you will see more and more things priced in yuan. Now, that's nothing new, or in the renminbi. That is nothing new. I remember when the first oil contract coming out of Saudi was priced in yuan, and everybody lost their minds in like 2015. You have seen kind of a slow whittling down of, but tiny, tiny bits. If you see still dollar trading volumes are still very, very high. They've not moved significantly lower. The death of the dollar, we could have discussions about the next 50 years, but it's not imminent and upon us. And treasury holdings from China, for example, you ever say, oh, China's selling all of our debt. Well, they've been declining since 2012. So for over 10 years. So some context is important. Of course, China wants to increase its sphere of influence. That's what the Belt and Road Initiative is about. That's what the String of Pearls Initiative through the South China Sea and into East Africa is all about. So I wouldn't be surprised if there is more and more of this banding together to try to find more influence within the financial markets. I don't know how much of a big impact it will actually have in the grand scheme of things. For now, it's just simply at the margin.
And Jim Bianco on this same show, he's very negative BRICS. He said, to his point, he said, I mean, Argentina's top two contenders for the presidency in the upcoming election, the opposition, both said they'll leave BRICS. So when you look from, no matter how bad you think our politics is, we're the best house on a bad block politically, and we're the best house anywhere in terms of legal structure and depth of our markets, liquidity, et cetera. So, I mean, I'm glad what the BRICS are doing for their own economies, but I don't think it's any threat to the dollar at all.
Can I go on a very short rant?
Go.
Absolutely.
Okay. So we debate a lot about asset allocation and the allocation to emerging markets. And we've been underweight emerging markets for a really long time. And I have been at different iterations and shops. And the reason being is because of that property rights and governance and all these things getting incrementally worse, not better. And it's interesting, if you look at every major bank's asset allocation models, they do these things called capital market assumptions. And they say, this is what we think this asset class is going to deliver over the long run. Well, over the long run, or over the last 15 years, capital market assumptions have had emerging markets having double the return of the US at double the volatility, meaning, yeah, you're going to take more risk, but you're getting more return. Well, you've had less than half of the return and double the volatility. So all of those assumptions about the asset class have been wildly wrong. Nobody's changed their models to say, well, maybe we should look at this differently. The reality is that, yes, the 2/3 of the economic growth have come from the developing world. But guess what? These markets are not mature enough compared to the US markets to deliver the kind of equity returns that everybody has been expecting. I think at the end of the day, the period that you had in the early 2000s of supportive emerging markets was as much of a bubble as any of the other economic bubbles that we've seen in the past. And people should be very cautious in extrapolating a 5 to 7 year bubble period into the future to justify owning an asset class or owning exposure to different markets that haven't necessarily earned their medal in portfolios. And if I say this and tomorrow we make some big major structural bottom in emerging markets, it would be absolutely poetic. We always look at it from a technical standpoint. I will change my mind if the charts change their mind, but I think that there's good rationale to be very skeptical about this idea that they can somehow generate double the returns.
Wow, that was a great rant.
Sorry for the rant.
Yeah.
No, are you kidding?
Or am I craw?
We love a good rant. Let's goodbye, Cameron, and get some of the charts you're doing. What do you got? Are you going back to work? Or are you done for the day?
Money never sleeps.
Money never sleeps. Amen, sister. Thank you so much, Cameron. And by the way, you are our favorite guest. You really are.
We'll see you guys.
See you. Bye. So, Bobby, let's trade something.
Yeah, I'm digesting that last answer because she's just so good.
Yeah, she comes at it. She's enthusiastic and she knows what she knows and she goes at it. I love it. I love every bit of it. Yeah.
If you don't mind, Jimmy, I want to put up the S&P future. Yeah, we'll go with SPY.
That's what I want. Yeah.
Let's go with SPY, and I'm going to put that up
because I might be changing my mind, and I'll tell you why. I want you to see if I'm crazy or not.
Yeah. So, from the perspective of what's happened the last few days, as I blather on before I can get this chart up.
No, keep filling dead air. That's
yeah, and so what I'm basically trying to say is, if you look at the S&P chart, okay, this is a weekly chart, and this is the SPY. And I'm actually going to remove something from it because it's not really pertinent to what I'm looking at right here. But if you guys remember, I talked about these rotation zones, right? And this is what I mean by a rotation zone: 8 exponential, 8 periods. So this is a weekly chart. This is an 8 week, and then a 21. And when you see a situation where we get a cross up over here, I don't trade that. We get to move into the rotation zone and it holds, into the rotation zone as it holds. Now we've got an actual rotation into the rotation zone. So the expectation for me, if we were to close with this sort of a pattern, is likely to be new highs in the start of a new bull market. Now, I don't know if we're going to do that. Okay, it'd probably be just short of the new highs, but once we get up there, you know how they reach for these things, right?
Right.
The only thing that bothers me is the volume. Like if I go to a daily, and again, this is approximate volume. It's unofficial. Look at the volumes here. You got here is the lowest volume since August 14th. Here you've got the lowest volume again since August 14th. There's not been a strong influx of money. And last week saw some of the biggest outflows of ETFs that we've seen in a while. So that'd be one of the things I would consider to be worrisome.
So it's funny because the trade over the last couple days, breaking out of that downtrend, going up above the high of the engulfing down bar from just a couple days ago, and settling above it. Yeah, and settling above it to me seems constructive. I want to see a solid settlement for the week, and then a little bit of a higher trade above that high, above the weekly high on next week, and then we'll be putting on some structured long trades. Remember, what we talked about before is, and I had hedges on that were working beautifully, and I traded around those hedges and didn't lose much money on the hedges. But now I could be changing my mind. It's in the nascent sort of infant stages of changing my mind. But I will, if I see some of those things happen in the next couple of days, I think I will put on some call spreads, etc.
So I'm doing something specifically here to show people the difference between a technically correct double bottom and just two bottoms. This is actually a technically correct double bottom. And what we look for in these things, by me, I mean me and Mike Arnold, and we'll have him on the show soon, is when you form a bottom and you get this rotation up, the second bottom needs to be in between 0.75 and 125 of this bottom. So that's why I have my Fibonacci's all done at 12.5 increments, right? 12.5%. And one reason so that I can do this, right? So I can just measure out, did this bottom get past 75% of this one? And is it short of 125? If this had been a bottom down to here, it would be a low probability double bottom. You also have to have a move that you're reversing, which we've got right here. And then the next thing I do is I flip this around in order to measure out a target. Okay, and I go from the higher low, not the lower low. And the first high probability target is this 175. And then the full target is this 200 extension, right? So it's like 1.75. So we're just short of the first target. And that first target incorporates this little gap in the SPY. And then the second target basically closes that gap. So I like this to continue up through here. And then this is a daily chart. So then the weekly will tell us what the rest of it is going to go. You know, somebody who we've had on the show, on the other show, our actual hour-long podcast, Mike Alfred, he tweeted today how if somebody could show me a Bitcoin chart that predicted there would be a good grayscale ruling, I'd like to see it. And my answer to him was technical analysis is about what, not why, right? So all we're looking at is what's the high probability move here? Like, what is it? And that's what I see there. So I think you're right on schedule with this.
Good. I'm afraid that I'm waiting for all my confirmations and I'll miss the biggest part of the move. But if I get some of the move, I mean, again, you make a little bit of money and then you live to move on to the next trade.
We got a viewer question for us. I could put it up again. It's from our friend Tim McLean, who watches everything, participates. I love Timmy. CRM reports today they use adjusted earnings instead of GAAP. Why don't short sellers call BS? I would argue that they do in certain companies. The problem with somebody like Salesforce is, they're using. So for you, those of you that don't know, GAAP, GAAP, stands for Generally Accepted Accounting Principles. I'd say, I don't know, what do you think, Jimmy? 70% of companies use non-GAAP, right? Mm-hmm. They release non-GAAP earnings. So in their view, they're transparent about it. So it's not wrong for them to do it. But we saw that back in the day with Tesla. I don't know if you remember where Tesla was like not paying vendors for a month and a half during the time before they were profitable, and then showing higher net profit for that particular segment of time. And then they paid all their vendors and they got crushed the next month. But if we went to generally accepted accounting principles, I think you'd see a lot more stocks at fair valuations. And they could explain what the issue is in the call, right?
Yeah. So there's nothing I can add to Bobby's answer, except for one thing, is that the people who are watching the show, the short sellers, companies love to bash short sellers. Everybody likes to bash short sellers. Short sellers are absolutely vital to this business for calling out bullshit, like you said. And I hate when they point the finger at them like, oh, these nasty speculator short sales, because that's bullshit. They do the dirty work and they do the forensic accounting that we don't do. And I know a short seller who was telling me that he had a guy wait in front of a shipping yard all night long to see how many trucks were coming in and out to call bullshit on numbers and then short the stock. That's the kind of work that we should be applauding, not bashing these guys.
Totally agree. I want to put up gold if we could.
Love it.
All right, let me put up gold here. I'm going to put up the same chart and just switch it to a gold one. So Jim and I, for those of you that don't know, we both do some commentary for the CME group, right? And what I said in my gold commentary the other day, and I'll point to the candle, it was right here. Okay, it was on this day. It was Friday the 25th. The metals is one of the things I do for them. And I said, I think people are missing out on how well gold is holding in with what's going on with rates. So just the fact that it kept above the 200 as rates were rising, as the 2-year got above 5%. And Jimmy, you did a fantastic 2-year note observation as well, an interest rate one for them that I saw today on Twitter. But you got this rotation in gold, and this was all during the course of rates rising, all in here. And then rates started to back off as the data came in lower and gold shot up. This to me is a very promising kind of a pattern. So when you look at the daily gold chart, and by the way, we could look at GLD if you want, or an ETF, or whatever ETF you want, but this is the gold futures contract. So when I talk about this rotation zone again, I've got a first cross here. It means nothing to me, okay? But what I do have is the potential for gold to fall maybe after a slightly higher than expected PCE number, maybe after a slightly stronger non-farm payrolls or wages, right? And then hold here. And if it does that, if it comes down here and holds anywhere between the 8 and the 21 and then turns back up, in my view, we're going here.
Got it.
We're going to 2004.
And I want to add something too, because Bobby and I, we kind of share the same brain when it comes to the way we trade, which we say is maybe 65 to 70% technical, 30% fundamental. But one thing that I do find interesting, and I mentioned it before with copper, is that there's a real live reason that copper should have been just trading like crap, and it wasn't.
Exactly.
There was a real live reason that gold should have been trading like crap, and it wasn't. That underscores perhaps that there's a bid somewhere that we don't understand, and that's why I pay more attention to those charts, and might be interested in buying some gold as well.
100%. And you know, those pullbacks that you get, that breakout, pullback, and hold, that brings reliability up by about 10%. We've got one more viewer question, Jimmy, and then we can probably call it. In your opinion, what would be, this is for you, Jimmy, in your opinion, what would be the best vehicle to use options to trade alongside the gold prices?
So, okay, so when you say trade alongside the gold prices, he just means to trade gold.
You know, let's say he wanted to buy calls here or sell puts based on what we just said.
Okay, so you have to remember that Bobby, to a certain extent, and me even more so, I'm a homer for the futures contracts. Bobby always makes the analogy saying, why trade the miners? Why just trade the underlying if you have an opinion on the underlying? I agree with that. I'm not licensed to talk about individual stocks, but I can talk about concepts. A lot of times people like the miners and the junior miners because they are so they are leveraged to the price of gold. And if you're right, they explode to the upside. However, if you're wrong, they explode to the downside too. That's part of the leverage thing. My personal opinion would be to use the CME futures, CME options on gold, which are very liquid. It's a big contract. Again, it's options, so you can scale your call spread so you don't have as much exposure to. Because what is it a 100-ounce contract, right?
Yep.
Maybe it's a 1,000-ounce contract, whatever it is. But anyway, so I would say that number one. I do occasionally trade the GLD. I actually have a position in it now, and I think those options are relatively liquid as well, and that's a decent contract. I know some people have a problem with it as far as do they actually have the gold, whatever. I don't. If you're a trader, I'm not sure that matters that much, particularly if you're using options. Bobby, do you agree with my answer?
I do, and if you just look at the GLD chart, you're seeing a lot of gaps here, and that's part of the reason I don't love trading commodities off of the ETFs like this. It's because you've got those hours of closure where you get these weird sort of gap movements, and they trade off of the gold futures contract anyway. Now, having said that, okay, these gaps can be huge advantages to you in the GLD options market. I don't know if it's liquid. That might be a question for Lex.
I've traded the GLD options before, and I think they were relatively liquid, but not as liquid as the CME.
Yeah, you might want to check out Lex's show or Bubba's show or one of the other guys and ask them how liquid the GLD is, because it'll trade alongside gold. You'll be able to watch the gold breakouts. But like Jimmy said, to me, it's 100% correlated to gold. So we should be in the gold futures chart. So,
all right. I gotta get back on the L.
Thanks for joining us, guys.
Thank you very much, guys. Thank you. And if you have any questions, contact Bobby on Twitter.
Yeah, I'm going to say real quick. Jimmy's out next week, but I've got a special sort of guest / co-host, Shayna Olczyk. I say no, it's Olczyk.
No,
She's going to kill me for that.
Orchik. She's great
Orchik.
though.
Yeah, she's
But
great.
I'm kind of bummed out because I have to be gone. I'm going on a hiking trip. I want her to be good, but not great. I don't want to be replaced. Okay.
No, she's going to be great. And by the way, she's big into ETFs. That's her thing. So you're going to want to watch this show. Her ETF knowledge is unparalleled. It's peerless.
She's awesome.
Yeah.
Thank you, guys.